Hey everyone, Brian Bogner and Greg Towner here with Parallel Portfolios. We're going to take the next few minutes and talk with you about why not only do we own international in our asset allocation here at Parallel, but why we think you as an investor should have exposure to international. Now, why are we even talking about this? Well, if we look here, over the last 10 years, U.S. large cap stocks have outperformed. So this is the performance of each asset class each year, and then the cumulative here. And as you can see at the top, U.S. large cap, U.S. tech large cap stocks have by far been the best performers over the last 10 years. So we get the question a lot. People look at their accounts or they come in and they say, hey, why are we owning international if this is where, all the money's being made? And so we're going to talk to you a little bit about that, because just because something has happened a certain way for the last 10 years, right, doesn't mean that moving forward it's going to be like that for the next 10 years.
Yeah, Brian, that's a good point, good way to start off. But also let's remember that the starting point in date is very important. I mean, if we went back another 5 years and used a 15-year starting point, emerging markets would actually be the top performing. And if you look at the column there for last year, 2017, we see that international and emerging were the top performers. So a lot of it is what time period you're looking at, but we'll evolve it into a deeper conversation today.
Yeah. And let's go back a little bit further. As you can see here, these are 3-year rolling periods comparing U.S. to international. And actually, it doesn't take a rocket scientist to figure out that this looks a lot like a sine wave, doesn't it? As it moves across here. And sure enough, we've had a 10-year period where the United States has been outperforming. And based on that and based on history would tell us that this 10-year period may be likely coming to an end.
Yeah, we talked about how last year emerging markets were the top performer, but certainly that's not been the case this year. Just in the last few months, emerging markets have really gotten hit hard. But this chart looks at kind of a rolling 3-month period of emerging markets versus large caps. And essentially what it tells us is if you're up near the top, emerging markets have been doing great, and down near the bottom, they've been underperforming. And so we're nearing that zone where in the last 10 years, a handful of times, it's kind of found a support area that it's bounced off of in relation to U.S. large caps. So we don't know if we're for sure there yet, but we could be getting close. Yeah, and one of the reasons that we think that you should continue to have exposure to international is certainly from a valuation standpoint. We can see there in the chart how much the U.S. has outperformed, but if we focus on the box area on the left, we can see that the S&P is trading at a price to earnings multiple pretty much in line with its 20-year average, but much higher than a broad international index. And that international index is also trading below its 20-year average, so much more value there. And similarly, when we look at the dividend yield, the U.S. about on its average of the last couple decades, whereas international is not only much higher than the U.S., but much more attractive than its 20-year average. So valuation doesn't always matter in the short run, but in the longer term, we think it will prove itself out. What we looked at last was a broad international view. This takes us even deeper into emerging markets. And we can see here that the recent sell-off has brought us all the way down to around 11 PE. It's roughly in line. If we go back a couple of years, you may recall that the Brexit scare that had a big sell-off. It's about in line there. Potentially we could get down to a 10 PE where we had 2-3 years ago some other China concerns. We don't know if we're going to go that deep, but it just shows you how much cheaper emerging markets and international is compared to U.S.
This chart here just talks a little bit about, for the last 30 years, even though, we showed you that chart earlier for that 10-year period where the U.S. had done the best, but if you look at each year what the top performing country is, the U.S. has never been the top performing country in any year. So, this is just a 10-year period here, but you can see Canada, Spain, Norway. Even when the markets fell apart back in 2008, Israel went down the least out of all of them. 2011, Ireland was the best performing. So, it is good to own markets outside of the United States. The United States is not always the best each and every year.
We really like this chart a lot, Brian, because this one of the key reasons for owning international is because over time, it can help reduce the volatility in your portfolio. So this blue line way over on the left shows what your standard deviation or volatility would be in your portfolio if you're 100% US equities going back to 1970. Following it way over to the far right, that's if you're all international, emerging, broad international, and so forth. But we see if we combine the two, kind of about a 40 to 50% blend of the two, you actually quite dramatically lower your volatility as if you own just one of them. So that's a key reason why we believe in owning international.
So summing it all up, look, we say this all the time. We're not trying to predict the future. We don't have a crystal ball here. So we don't know when international is going to outperform again. So we always will maintain exposure to international. We may overweight, underweight, things like that, but we'll always have exposure there. And again, the last 10 years, just because we've had strong U.S. outperformance doesn't mean the next 10 years are going to look like the last. So, and we actually believe that, we could be entering a transition where U.S. outperformance starts to wane, and we start to see that coming in internationally. And just as Greg mentioned, valuations certainly are much more attractive overseas than they are here in the U.S. And when you have international in your portfolio, it will lower your volatility. So that's another reason why. So if you have any questions, give us a call, shoot us an email. As always, we thank you so much for your time. Have a great day.